Making money multiply is easy when you have all the right tools, information, mindset, and some discipline. When you're truly ready to watch your net worth blast off, this video is going to be your launch pad. Alongside myself, I compiled 4 of the best YouTubers that I could find in their industry and in their expertise, and we decided to make a video that's truly going to help you. Straight up, this video is not short. So if you want super short, and possibly some dancing or something, maybe go check out TikTok. But if you're serious about increasing your net worth and making 2025 your best year financially, I recommend that you listen to every minute in this video. We're gonna be going over 6 of the best ways to be making lots of money in investing. Some of these are gonna hit well with you, and some of these are not gonna be your particular brand of investing, but you'll be a much more informed and educated investor and well-rounded in this field just to understand each of these things. I'm gonna have timestamps down below because I know for a fact that you're gonna come back to certain sections of this video later on, so I wanted to make this as easy as possible for you. I'll also have links down below to each of these creators and to their channels so you can check them out individually after you listen to everything in this video. So here's the best way to invest. And real quick, I'd love to hear from you. What's your favorite way to invest and what's your favorite investment? Go ahead and throw that down in the comment section below so that we can all learn from one another. Whether it be stocks or bonds or real estate or Beanie Babies or Steve Nash rookie cards, I'm definitely interested. My name's Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. So I'm gonna start us off in one of my favorite ways to invest, and really the one that's made me the most amount of money in the shortest amount of time, and that would be real estate. And today I'm gonna be talking about physical real estate. Because REITs are great, and investing digitally in real estate in that way is awesome, especially for cash flow, but I choose to invest mostly in actual physical real estate. And I'm gonna keep this one short and sweet because I do talk a lot about this on my channel, but here's 4 main reasons why I really love this way of investing. The first reason why this is such an amazing way to invest is one that we all understand probably, but it's because of that cash flow. You can charge people rent, and the rent over time can be increased with inflation while the mortgage payment itself stays the same. So if the mortgage is $2,500 on the home and the market rate for rent is $3,000, you get to pocket $500. In 5 years, the market rate for rent will probably be up about $500, so now it's $3,500 for rent, but your mortgage stayed at $2,500, so now you get to pocket $1,000 per month. Number 2, tax breaks and deductions. This one is so big because as I work with my private financial coaching clients on ways to be able to tax shelter or save on taxes, there's really only a couple real legal ways that you can do so, and real estate is one of the best. You get to write off the fact that the house is depreciating, while in reality, the house is actually becoming more valuable, so it's such a hack. The third reason is obviously appreciation. We all know that one person that bought a house for $50,000 30 years ago, and now it's worth $700,000. That's a pretty awesome appreciation on their investment. Real estate tends to go up 4 to 6% per year, and sometimes goes up a lot more. I know when I bought my first home right before COVID, within those next 2 years, my house appreciated about $200,000, so I made $200,000 in equity in 2 years just by owning this house. The last thing I love about real estate and just investing in real estate in general is leverage. Obviously, you can use leverage on most investments, but specifically with real estate, I tend to think that it's just a little bit safer since you're actually buying a physical piece of property. If you want to buy a $500,000 house, you could buy it for as little as 3.5% down, which is basically under $20,000 to own this house. As far as an investment property, they usually want closer to 10 to 20% down, but still, you get to pay only $100,000 to own a home that's worth $500,000 and start collecting rent on it right away. Real estate is just a great way to get very wealthy. All right, enough from me. This next guy has some solid info, and his channel is packed full of value. Chris Sane is one of the top guys in the investing and specifically options investing space. I found out about him because one of my good friends, Howard, came up to me one day and said, "This dude Chris Sane never misses. His picks are on point." Side note, this kombucha that I'm drinking is literally the best kombucha that I've ever had, and it's from my friend Howard's company, Everlasting Ferments. This kombucha is not as sour as most others and very lightly carbonated, so you could drink it whenever. I'll link to his website down below, so if you're in Southern California, definitely do yourself a favor and get some bottles. All right. Here's my guy Chris Sane on exactly how you could make a bunch of money in a pretty quick amount of time.
Shout out to Professor G, one of my faves in the finance space. He asked me about options, and what comes to mind for me, guys, is this. Although I'm an investor at my core, I built my bones through investing. I do feel like once you get to a point of having your long-term portfolio established, there's really nothing more to do. And that is what led me down the road of just exploring with options, because my long-term wealth was firmly established. And guys, what it did for me is this. It challenged me from a critical thinking standpoint. I thought, and I've always said every day in my videos, options, when done right, it is not gambling. It is, matter of fact, a technical skill that you must learn through constant and consistent practice. It is also a way to supercharge your wealth on top of the money you've already established through consistently investing, dollar cost averaging, buying the dips, buying when the market is low. So for me, I use options as a way to, again, test the technical part of the market, meaning using charts, using indicators, using the tools that's at our disposal to make educated, practical decisions. And so for me, guys, every day, I'm a guy that shows up to teach you the lesson, and then the next day in the market, we go out and apply what is learned. That has allowed me to help create some of the most successful investors and traders on the planet, because you're following a method that's replicatable and duplicatable. And when you can do the same thing consistently, not that it will show up every day, but when you can know, I recognize that pattern from a lesson that was taught last week. I recognize that pattern for a lesson that was taught last month. I recognize that pattern through one-on-one coaching. Then, guys, you can get some consistency in your trading, so you remove the feeling that it's gambling. Sometimes that's the connotation some try to apply to trading options. With me and what I do is nowhere near gambling. Every single day I can show you down to a T how to make $100 a day or how to make $1,000 a day consistently. But I'm doing it through technical analysis. I'm doing it through chart and pattern recognition. I'm doing it through high quality and high probability trade setups. What that allows me to do is go to the drawing board each and every day and have similar success throughout the week. When you can build consistency in your trading as well as managing your risks, guys, the game becomes a beautiful one that, again, I often say is the greatest vehicle for wealth creation. So again, guys, when done right, when proper risk management is being displayed, meaning I often say it's okay to be wrong, but it's not okay to stay wrong. So you need to recognize that, acknowledge that, and cut the loss if you have to. You need to pivot if you have to. These are things you must do if you want to become a consistent trader, which is how you become a profitable trader. There are steps along the journey that you must follow. There's tuition to pay. There's lessons you must learn that only through getting your feet wet and only through trial and error can you reach that level that, again, allows you to reach a level of mastery, allows you to reach that elite level trader status where you are not only profitable, but you can replicate it consistently, daily, weekly, and monthly. That is where you want to get to. That is where you want to be. So for me, guys, I love investing, but more importantly, alongside that, I dabble into trading because it's the way to just keep me sharp, and it's a way to supercharge my wealth. Hopefully that lesson helped you guys on the day. Please feel free for more information to tap in. I show up 7 days a week, teaching and coaching, showing you guys real skills that we can go out and practice the very next day at market open. That sounds like a plan. Tap in.
Next up is one that many traditional investors have just been sleeping on, and I would highly recommend that you just take the next 5 minutes and listen and educate yourself on this piece. Many people didn't trust the internet back in the 1990s, and then seemingly overnight, that technology disrupted almost everything, and for those who adapted quick, they got very rich. My next guest is named Brian DeMint. He's a serial entrepreneur, a jiu-jitsu black belt, and author of 2 of the best books on the subject and bestsellers on Amazon, and his channel is called Freshly Minted. I literally learned something new listening to the end of his piece, so stick to the end to get your mind blown.
Hi, my name's Brian DeMint, and I'm here today to talk to you about the Bitcoin investment thesis. We're going to look at Bitcoin through 3 traditional lenses. First, we're going to take the value investing approach. Second, we're going to look at the tech adoption curve. And third, we're going to look at Bitcoin through a historical investment perspective. And if you guys stick around, I'm going to give you a crazy fact at the end about Bitcoin that might just blow your mind. So let's dive into the Bitcoin investment thesis. First up, we're going to look at Bitcoin through the value investing lens. The value investor is always looking for the inherent value of something versus the market value of something. So what is something intrinsically valued at versus what are people currently paying for it? And for all of you Warren Buffett value investors out there, you guys should be going absolutely bananas over Bitcoin. Here's why. What's the value of just American money transmitters? I'm not talking about worldwide money transmitters, which is much, much bigger. So we're just talking about American Express, Visa, MasterCard, Venmo, PayPal, Western Union. The combined market cap of those companies is over $2 trillion. What's the market cap of Bitcoin today? It's $1 trillion. Now, Bitcoin is hundreds of times faster, it's hundreds of times cheaper, and Bitcoin doesn't need a second, third, or fourth middleman in order to execute a transaction. So if the inherent value of sending money in the United States is $2 trillion, that's a 100% increase on the current value of Bitcoin. Wouldn't you love to pay $1 today for something that's worth $2? Well, that's what we have before us with Bitcoin. Next up, we're going to look at tech adoption. When things go from analog to digital, they always become more valuable. And we see this with something like paper maps. In the biggest year ever for paper map sales in the United States, they only did about $40 million. Now let's compare that to digital maps. What kind of economic activity do digital maps account for? About $200 billion, that's right, billion dollars every single year. So digital maps are about 4 orders of magnitude bigger than paper maps. We see the same thing with encyclopedias. In the best year of sales ever for encyclopedias, they did about $70 million in sales. So let's just take a look at Google alone, which is like a digital encyclopedia. In just the last 12 months, Google has done $328 billion in gross revenue. So again, digital encyclopedias are about 4 orders of magnitude or nearly 5,000 times more valuable than their analog counterparts. Think, digital is always more valuable than analog. The good news here is that Bitcoin is digital gold. It has all of the great qualities of gold, plus it's digitally native. What's the market cap of gold, you ask? Well, it's about $13 trillion. So let's say that Bitcoin underperforms and it doesn't have a 4 orders of magnitude increase. It just has a 1 order of magnitude increase. Then that puts Bitcoin at a market capitalization of $131 trillion, also known as a $6.2 million Bitcoin. Everything that was analog is going digital, and digital things are always more valuable than analog. This is the tech adoption cycle. Next up, we're going to look at the historical perspective. 100% of sovereign currencies fail, and the things that made fiat currencies fail in the past are present in the fiat currencies that we have today. So we're dealing with a checkmate situation. We know exactly what is going to happen, and we know the moves that we have to make. Why? Well, because there's no mechanism to throttle the government's ability to spend at will. Historically, what has always been the fix to broken, failing forms of money? The answer is sound money. Bitcoin is the fix to this because its rules are immutably written into code just like a constitution. But this constitution cannot be changed by anyone. And one of the most important rules written into that constitution is that there are only ever going to be 21 million Bitcoin. It's a fixed, finite supply. So what happens when you measure something that is being created infinitely by something that is fixed or finite? Let's go ahead and do some basic math. Whip out your calculator and divide infinity by 21 million. What do you get? And like I told you, I'm going to give you a bonus fact about Bitcoin that might just blow your mind. In 2022, billionaire Michael Saylor,
Let me tell you about my best friend.
Founder of MicroStrategy, yes, that little company that's outperformed Nvidia, Tesla, and Apple in the last 12 months,
said in 2022 that if Bitcoin gets 3 pieces of infrastructure, that it will go to $5 million. Well, according to Michael Saylor, first up, it would need a spot Bitcoin ETF. Next up, it would need a change to the FASB accounting rule. And then third, regulation would need to change so that banks could custody Bitcoin. Well, guess what's happened in the last 12 months? That's right. Bitcoin ETFs launched. Not only did they launch, they were the most successful ETF launches in the history of ETFs. Next up, a change to the fair accounting rules around Bitcoin changed favorably for companies to be able to hold Bitcoin in their treasuries and on their balance sheets. This is game changing. Last but not least, guess what happened just in the last 2 weeks? That's right. The US government approved banks to be able to hold Bitcoin on behalf of their customers. Those puzzle pieces have just been put into place. And over the next 5 years, Michael Saylor expects Bitcoin to climb to $5 million per coin. And there you have it. Those are the 3 elements for the Bitcoin investment thesis for traditional investors. My name's Brian Dement, and I'll see you next time.
This next segment is going to be by a man who needs no introduction, especially if you've been watching my videos for any period of time. This is the best in the business on dividends, and his name is Ryan Williams. He consistently puts out the best information on dividends on his channel and has so many resources to help you earn passive income for life. I'm excited to see what he has to say here.
So first off, I want to give a big thanks to the Professor G for including me in this video. I am so stoked to talk to you guys today about dividend investing, which in my opinion is hands down the best and easiest way to create passive income. One of the main reasons I personally choose to only invest in dividend paying stocks is because the dividend payments are not impacted by the random whims of the stock market. In other words, no matter what the share price is doing, whether it's going up or it's going down, you're still going to receive your dividend payment. Now, as we all know, share prices can fluctuate pretty dramatically, and it's not uncommon for that to happen as a result of things that aren't really related to the company's actual financial performance. Certain news can come out and a company's share price can either plummet or soar just based on whatever that news is. Dividends, however, are always rooted in the company's actual operations and its ability to generate profits and free cash flow. If a company isn't growing and if it's not profitable and generating free cash flow, then it will not be able to sustainably pay and grow its dividend. So in a way, at least this is how I think about it, it kind of forces you to invest in fundamentally strong companies, and those are the kind that you should want to own anyway. On top of that, dividend investing is incredibly straightforward, and it's a very low stress, low maintenance way to invest. Okay, you just buy the stocks, hold on to them, and collect the income. That's literally all it takes. And since it's naturally a buy and hold strategy, you don't have to worry as much about trying to time the market. And this is very important, you don't have to sell your shares down the road to be able to benefit from the investment, which is something that you just can't say for non-dividend paying stocks. And honestly, that's something I've never fully understood about the non-dividend payers. Why would I want to own something where the only way to get any sort of benefit out of it is by selling it? I mean, that type of investing works just fine for a lot of people, and there's certainly more than one way to do things, but that thought has just never sat well with me. Why would I want to work so hard and spend decade after decade after decade building up my portfolio, building up my collection of assets to only have to sell it off down the road? With dividend paying stocks, I can have this cash-based relationship with my investments where they just give me a paycheck for being a shareholder. Depending on the business, that paycheck could keep coming even after I'm no longer here. And now we're talking multi-generational wealth, which is awesome. Now, having said all of that, dividend investing certainly has received criticism over the years. Many people say that, instead of paying out a dividend, a company would be better off reinvesting in the business for more growth or buying back shares. And there is some truth to this. Some companies can probably generate higher returns on their capital, reinvesting it instead of paying it out as a dividend. That's true, but there are a lot of companies out there where the best use of it for shareholders is to pay it out as a dividend. And this is another key point about dividends. They can help hold the management team accountable. If a company were to retain all of its earnings, there'd be pressure on the management team to find ways to invest that capital, even if there aren't great opportunities out there to do so. And the reason for this is because they just need to stay busy, I guess. The management team is being paid a lot of money. And so one way they can justify being paid as much as they are is by staying active. And for them, any activity looks better than no activity. But the risk that comes along with the need to keep up that appearance is that it can lead to bad capital allocation decisions, like, for example, bad acquisitions, which ultimately is going to do more harm than good for the company. By committing to paying a dividend, management has less capital to work with, which once again could be a good thing or a bad thing depending on the company. But it does force them to be more strategic and selective in how they allocate capital. In other words, having less capital to work with helps make sure that what they do have is put to better use. And all of that is something Warren Buffett has talked about quite a bit. In his 1989 shareholder letter, he refers to what he calls the institutional imperative, which essentially describes a situation in which companies tend to follow certain decision-making patterns, often resulting in bad outcomes. As he puts it, just as work expands to fill available time, corporate projects or acquisitions will materialize to soak up available funds. And like I said, that can lead to bad uses of capital and ultimately poor returns for shareholders. But anyway, guys, in a nutshell, dividend investing is a very simple, very straightforward way to invest and create passive income. This type of strategy allows you to focus on building long-term wealth without having to someday sell off your assets down the road. Like I said earlier, all you need to do is buy the stocks, just hold on to them and collect that income, and then repeat.
The next gentleman on this list is going to be going over the exact opposite as far as style for investing, but still investing in individual company stock. These are going to be the fun and exciting stocks that can definitely boost your portfolio to the moon very, very quickly. Tom Nash has an awesome YouTube channel where he talks a lot about growth stocks and just overall investing, so definitely go check that out.
Folks, I believe that long-term investing creates generational wealth. And I've said it multiple times before, one of the best investments any individual investor can make is the S&P 500. But I also believe that you can spice up your S&P 500 holding and add some generational winners to that portfolio to make it even better than 10% per year. Now, I'm not arguing to go against the S&P 500. That thing is undefeated. It's a juggernaut. But all I'm saying is you put a portion of your portfolio in winners and individual stocks that will be around in 10 years dominating their industry. That investment can take your portfolio from 10% a year to a whole new stratosphere. Now, the way you do it is, first of all, by not gambling, by understanding it's all about long-term horizon, and by studying some important skills like how to evaluate companies, how to identify such long-term generational winners, and by understanding that time is the best friend of a great business, which means that sometimes prices in the short term of great companies might be volatile, might be down because of market sentiment, because of psychology, because of manipulation, whatever it may be. But long term, if you stay long enough, the same way you do with the S&P 500, long term, if you have selected great generational companies, those companies will defeat the short-term market sentiment. Now, my point here is very simple. Focus on the S&P 500. Make sure at least 40 to 50% of your portfolio is in a large index fund. And the other half, make sure you select wisely, because selecting a stock for the next 20 years is pretty much like marriage. You don't just marry anybody. You want to marry the love of your life. The same thing with stocks. Find your own stock that you believe will be dominant on the next 10 years. Find a couple, 2, 3. Don't go overboard with selecting 20 stocks. You probably should max that at 5 tops. Make the research. Understand the valuations, and make the long-term commitment to dollar cost average into these companies. If you dollar cost average and you actually DCA, dollar cost average double on weakness, and you do that over the course of the next 10 years, assuming you've selected good companies, the market is going to reward you with some incredible results, a lot better than just the 10% you can get out of the S&P 500. Now, of course, you're going to have some bad years, you're going to have some great years, but when you look at this portfolio in hindsight, when you zoom out and you look 10 years into the past, you're going to see how great the market treated you because you understood one little principle. Time in the market is way more important than timing the market. Stay in the market, focus on a large index fund, and focus on finding 2, 3, 4, maximum 5 generational winners to spice up your portfolio and dollar cost average into the afterlife.
So now back to me for number 6. And if you're a part of my channel, you know exactly what I'm going to talk about, but I'm going to give you some new information here today. This style of investing is usually what pretty much all investors at least have a little bit of their portfolio in. For me, it makes up the vast majority of my portfolio, and I'll tell you why. When looking at the S&P 500 versus fund stocks like Nvidia or Palantir, or looking at dividend type stocks or even REITs with all those fun little cash flows, S&P 500 is quite boring. It generally goes up about 10% per year, but it's not going to be the investment that makes you triple your money in 1 year. What I love about ETFs or index fund investing the most is that it gives me what I believe is actually more valuable than money, and that's time. I get to invest in something that's gonna beat inflation and grow like crazy long term with compound interest, but also that I don't need to spend hours of my day researching. If you invest in individual stocks, you have to stay up on the company and the CEO and the competitive advantage and even the competitors themselves and the industry. The stock could go down 40% in 1 day if you're not up to speed on it. ETFs stay relatively stable, especially if you stick to broad ETFs like VOO for the S&P 500 or VTI for the total US stock market. And ETFs or index funds do all the work for you. When an individual company does really well, the fund is probably going to pull that up and have more exposure to it within the actual fund. Just like how Nvidia has grown like crazy over the last year, and because of that, because its market cap has grown, it has a much larger piece within the S&P 500. And so now, since I was investing in the S&P 500 all along, now I'm invested in Nvidia and at a pretty high percentage. And vice versa, if a company's doing pretty terrible quarter after quarter, after a little bit, the fund itself kicks those bad companies out, so now it's not dragging down your portfolio anymore. I didn't have to research to figure out which ones I need to kick out, and I didn't have to deal with any taxes because it got kicked out. That's just what happens because the ETF does the work for me. ETFs are considered to be low-risk investments because they're low cost and hold a basket of stocks or other securities, increasing diversification. In addition, ETFs tend to have much lower expense ratios compared to actively managed funds, can be more tax efficient, and offer the option to immediately reinvest dividends. One ETF can give investors exposure to many stocks from a particular industry, investment category, country, or a broad market index. ETFs can also provide exposure to asset classes other than equities, including bonds, currencies, and commodities. My 3 ETF portfolio is the best way I've found for any investor to invest in, and it's what literally over 95% of my equities portfolio is invested in. It keeps things very simple, has gained an average of over 13% per year over the past 10 years every single year, and I have more time and peace in my life to be able to spend that time doing things that I want with my friends and family, which is much more important than looking up anything in the finance realm. I've linked to each of the creators' channels down in my description below. Watch this video to learn more about that simple 3 ETF portfolio that's taking over the world, or watch this video to keep you going strong in your investing journey.